Let me ask you something that will reveal more about your investment philosophy than any stock pick ever could. If you knew you only had a limited time left and you could only pass down 3 investments to your children and grandchildren, investments they would hold for the rest of their lives, what would you choose? Most people freeze when I ask them this question. They start rattling off their favorite stocks. The ones that have performed well recently, the ones they read about in the financial news. But that is not what I am asking. I am asking about investments that will compound wealth across generations. Investments that will still be valuable 50 years from now, 100 years from now. Investments that require no special knowledge, no constant monitoring, no brilliant timing, just patience and time. I have thought about this question more than almost any other investment question because it is personal to me. I have accumulated more wealth than I ever imagined possible, and the question of how to pass it on responsibly has occupied my mind for decades. What I have concluded might surprise you. It is not complicated. It does not require genius, and it is available to anyone, whether they have $10,000 or $10 million. Let me take you back to 1977. I was 47 years old, and I had just made one of the most important decisions of my investing career. I had been running my partnership for years, picking individual stocks, analyzing businesses, looking for undervalued opportunities, and I was good at it. Very good. But something happened that year that changed how I thought about generational wealth forever. My daughter Susie came to me with a question. She was in her early 20s, just starting her adult life, and she asked me what she should do with some money she had saved. Now, I could have given her my best stock picks. I could have told her about the undervalued companies I was finding. I could have taught her everything I knew about reading balance sheets and evaluating management, but I did not do any of those things. Instead, I told her something much simpler. I said, buy a low-cost index fund and never sell it. She looked at me like I was crazy. Here I was, spending my entire life picking individual stocks, and I was telling my own daughter to just buy the whole market and forget about it. But here is what I understood then. That took me decades to fully appreciate. What works for me, what I have dedicated my life to mastering, is not what I would recommend for the people I love most, because I know the odds. I know that 90% of professional money managers fail to beat a simple index fund over any meaningful time period. I know that the more you trade, the more you lose to fees and taxes and mistakes. And I know that the greatest advantage any investor has is time, not talent. That conversation with my daughter planted a seed that grew into a conviction I now hold with absolute certainty. The best investments to pass down to your family are not the cleverest or the most sophisticated. They are the simplest, the most durable, and the most likely to compound without interference for generations. Today, I am going to share with you the 3 investments I would pass down to my family if I could only choose 3. These are not just theoretical preferences. These are the actual instructions I have left for my estate. When I am gone, 90% of the cash left to my wife will go into a very low-cost index fund. The remaining 10% will go into short-term government bonds. That is it. No complex strategies, no hedge funds, no private equity, just simple, boring, generationally powerful investments. But I am going to go further than that today. I am going to explain exactly why these 3 investments work across generations, how they protect against the mistakes that destroy family wealth, and why they are available to you right now, regardless of how much money you have. More importantly, I am going to share the principles behind these choices, because if you understand the principles, you can adapt them to your own family situation. The first investment I would pass down to my family is a diversified portfolio of dividend-paying blue-chip companies. Now, I know what some of you are thinking. You expected me to start with an index fund that is coming. But there is a reason I am starting here, and it has to do with the psychology of generational wealth transfer. When you pass down investments to your children and grandchildren, you are not just passing down assets, you are passing down a relationship with those assets. And here is what I have learned over 9 decades of living and 7 decades of investing. People sell index funds, They sell them during crashes. They sell them when they get scared. They sell them when they need money and see a big number that feels like enough. But do you know what they rarely sell? Dividend checks. There is something psychologically different about an investment that pays you every quarter when the market crashes and your index fund is down 30%. Everything in your brain screams to sell. But when your dividend portfolio is down 30% and you are still receiving checks in the mail, something else happens. You feel like a business owner, not a gambler. You are receiving your share of the profits. And studies show that dividend investors hold their positions through volatility far better than growth investors. Let me tell you about my experience with Coca-Cola. I bought my first shares in 1988. I have not sold a single share since then. Not one. The stock has been up, down, sideways. The company has faced challenges from health trends, from competition, from changing consumer preferences. But every quarter, without fail, that dividend check arrives. And every year for more than 30 consecutive years, that dividend has increased. Today, the dividends I receive from Coca-Cola each year represent a return of over 40% on my original investment, not the total return, just the dividend. Every single year, that is the power of dividend growth compounding over time. And that is why I would want my children and grandchildren to own businesses like this. When you own a company that has paid and increased its dividend for 50 years, you own a piece of business history. You own something that has survived recessions, wars, technological disruptions, and every other challenge the economy has thrown at it. Companies do not maintain dividend streaks like that by accident. They do it because they have durable competitive advantages, because they generate more cash than they need, because they are managed by people who understand their responsibility to shareholders. Think about what happens when you pass down a portfolio of dividend aristocrats to your grandchildren. They receive income every quarter. That income grows every year. They see the tangible benefits of ownership. They are far less likely to sell in a panic because they do not want to give up that income stream. And over 30 or 40 years, the compounding of reinvested dividends creates wealth that seems almost magical. Here is a number that will astound you. If you had invested $10,000 in a diversified portfolio of dividend-paying stocks in 1960 and reinvested every dividend, you would have over $4 million today. 400 times your original investment, and you would be receiving over $100,000 per year in dividend income. Your original $10,000 investment would be paying you more than 10 times its initial value every single year. That is generational wealth. That is the kind of investment that changes family trajectories. And it requires no special skill, no market timing, no sophisticated analysis, just patience and the discipline to never sell. Now some people will object. They will say dividend stocks underperform growth stocks. They will point to technology companies that have returned thousands of percent. And they are not wrong about the numbers, but they are wrong about the application. Growth stocks are wonderful for building wealth during your accumulating years. But for generational transfer, the stability and psychology of dividend income is far more valuable than the potential for higher but more volatile returns. The second investment I would pass down to my family, and this is the most important one, is a low-cost index fund that tracks the entire American stock market. Specifically, I would choose a fund that tracks the S&P 500. This is not just my recommendation for my family. This is my recommendation for almost everyone. If you do nothing else with your investment life but buy a low-cost S&P 500 index fund and hold it forever, you will outperform the vast majority of professional investors. Let me explain why this is so powerful for generational wealth. First, you are buying a self-cleaning index. The S&P 500 is not a static list. Companies that fail get removed. Companies that succeed get added. In 1980, the largest companies in the index were IBM, A&T Exxon, and General Electric. Today, the largest companies are Apple, Microsoft, Amazon, and NVIDIA. The index automatically adapts to economic change. Your grandchildren do not need to know anything about which industries will dominate in 2060. The index will figure it out for them. Second, you are buying at costs that would have seemed impossible a generation ago. When I started investing, if you wanted to buy a diversified portfolio of stocks, you paid significant commissions on every trade. You paid hefty management fees to mutual funds. The friction of investing consumed a meaningful percentage of your returns. Today, you can buy an index fund with an expense ratio of 0.03%. For every $10,000 you invest, you pay $3 per year in fees. That is essentially free third. And this is the most important point for generational wealth. You are removing human error from the equation. The biggest destroyer of investment returns is not market crashes. It is not inflation. It is not bad companies. It is investor behavior. People buy high and sell low. They panic during crashes. They get greedy during bubbles. They trade too much. They think they are smarter than the market. When you pass down an index fund to your grandchildren with clear instructions to never sell, you are giving them the gift of protection from their own worst instincts. You are saying, I do not trust any of us to be smarter than the collective wisdom of the market, and I do not need to be. I just need to own a piece of everything and let time work its magic. Let me share some numbers that illustrate this power. Over the past 100 years, the S&P 500 has returned approximately 10% per year on average. Some years it is up 30%. Some years it is down 30%. But over long periods, that 10% average holds remarkably steady. Now think about what 10% compounding means over multiple generations. If you invest $100,000 today and it compounds at 10% for 50 years, your grandchildren will have $11.7 million. If it compounds for 75 years, your great-grandchildren will have $137 million. If it compounds for 100 years, the number becomes so large it seems unreal. $1.3 billion from a single $100,000 investment. That is the power of compound interest across generations. Now I know what some of you are thinking. 10% is not guaranteed. The future might be different than the past. And you are absolutely right to think that way. But here is what I believe with high confidence. American business will continue to grow. It will continue to innovate. It will continue to generate profits. Companies will continue to earn returns on their capital. And an index fund that owns a piece of all of it will continue to reflect that growth. I have bet on America my entire life, and I have never regretted it. Not once, through world wars, through recessions, through political crises, through technological disruptions. American business has always found a way to grow, to adapt, to create value. And I see no reason why that will change in the next 50 or 100 years. The key to making this work across generations is simple. Never sell. I cannot stress this enough. The moment you start trying to time the market, to get out before crashes, to get back in when things look better, you destroy the compounding engine, you introduce human error. You pay taxes, you pay fees, you lose. The best investment decision your grandchildren can make is no decision at all. Just hold through crashes, through bubbles, through wars, through whatever the world throws at them. Just hold and let time do its work. The third investment I would pass down to my family is something different from the first two. It is not a specific stock or fund. It is an ownership stake in a quality business, either directly or through a company like the one I have spent my life building. The reason I include this is because I want my family to understand something fundamental about wealth creation that you cannot learn from owning an index fund alone. When you own a piece of a real business, you develop a different relationship with capitalism. You understand that behind every stock ticker is a company with employees, with customers, with products, with challenges, with opportunities. You learn to think like an owner, not a speculator. And that mindset is perhaps the most valuable thing I could pass down to future generations. Let me tell you what I mean by a quality business. A quality business has a durable competitive advantage. It has something that protects it from competition, something that allows it to earn high returns on capital year after year. It might be a brand that customers love. It might be a network effect that gets stronger as more people use the product. It might be cost advantages that competitors cannot replicate. Whatever it is, it creates a moat around the business that protects its profits. A quality business generates more cash than it needs to maintain its operations. This excess cash can be returned to shareholders through dividends and buybacks, or it can be reinvested to grow the business. Either way, the owners benefit. A quality business is run by honest and competent managers who think like owners, not employees. They make decisions based on long-term value creation, not short-term stock price movements. When you own businesses like this, you can hold them forever. You do not need to watch them constantly. You do not need to worry about quarterly earnings reports or analyst opinions. You just collect your share of the profits and let the business compound. Here's a story that illustrates this perfectly. In 1972, I purchased a company called See's Candies for $25 million. At the time, See's earned about $4 million per year before taxes. Some people thought I paid too much, but I saw something they did not see. I saw a brand that customers loved. I saw pricing power. I saw a business that would generate cash for decades with minimal reinvestment. Since that purchase, See's has generated over $2 billion in pre-tax earnings. $2 billion from a $25 million investment. And the business is still running, still generating cash, still delighting customers with the same chocolates they have loved for over a century. That is what I want my family to understand. That is the kind of ownership mentality that creates generational wealth. Not trading stocks, not timing markets, not chasing the next hot thing, just owning pieces of wonderful businesses and holding them while they compound. Now I realize that not everyone can buy an entire business like See's Candies, but you can own pieces of businesses through stocks. And if you own them with the right mindset, if you think of yourself as a part owner rather than a ticker symbol trader, you will make better decisions. You will hold through volatility. You will focus on business performance rather than stock price movements. And over time, you will build far more wealth than the traders ever could. Let me now pull these three investments together and explain the principles that connect them. Because if you understand the principles, you can apply them to your own situation regardless of how much money you have. The first principle is simplicity. Every single one of these investments is simple to understand. Dividend stocks pay you income that grows over time. An index fund owns a piece of everything. A quality business generates cash for its owners. There is nothing complicated here. And that simplicity is a feature, not a bug. When things are simple, people can stick with them. When things are complicated, people make mistakes. The second principle is durability. All three of these investments have stood the test of time. Dividend-paying companies have been rewarding shareholders for over a century. The American stock market has grown through every conceivable crisis. Quality businesses continue to generate profits decade after decade. You do not need to predict the future when you own things that have survived the past. The third principle is minimal intervention. The greatest enemy of investment returns is activity. Every trade creates friction. Every decision creates the opportunity for error. The best investments are the ones that require no decisions at all. Just buy and hold forever. The fourth principle is psychological alignment. I have chosen these investments specifically because they match how human psychology actually works. Dividend income makes people feel like owners, not gamblers. Index funds remove the temptation to trade. Quality businesses reward patience and punish impulsiveness. The investments work with human nature rather than against it. The fifth principle is tax efficiency. When you hold investments forever, you never pay capital gains taxes. Your wealth compounds pre-tax over multiple generations. This tax deferral becomes enormously valuable. Trading, on the other hand, triggers taxes constantly. It is a hidden cost that destroys returns over long periods. Now, let me talk about how you can apply these principles to your own family situation, because the specific investments matter less than the principles behind them. If you have a modest amount to invest, I would suggest starting with just one thing, a low-cost S&P 500 index fund. Put money into it every month, regardless of what the market is doing. Never sell. Tell your children to never sell. Tell your grandchildren to never sell. That single investment held for multiple generations will create more wealth than any clever strategy ever could. If you have more to invest, you can diversify across all three categories. Put some into the index fund for broad market exposure. Put some into dividend-paying stocks for income and psychological stability. And if you have the knowledge and temperament, put some into individual quality businesses that you understand and can hold forever. But here's what I want you to understand above all else. The specific investments matter far less than the holding period. A mediocre investment held for 50 years will outperform a brilliant investment held for 5 years. Time is the great equalizer. It smooths out volatility. It allows compounding to work its magic. It forgives mistakes, and it rewards patience above all other virtues. When I think about what I want to leave my family, it is not just money. It is wisdom. It is the understanding that wealth is created slowly over decades and generations through the patient ownership of productive assets. It is the discipline to never sell, to never panic, to never think that you are smarter than the market. It is the humility to accept that simple strategies outperform clever ones. The richest families in America did not build their wealth through trading. They built it through ownership. They bought pieces of businesses and held them for generations. They reinvested dividends. They let compound interest work. They ignored the noise and focused on the fundamentals. You have the same opportunity today that the great wealth builders had a century ago. Actually, you have better opportunity because today you can buy a piece of the 500 best companies in America for essentially zero cost. You can reinvest dividends automatically. You can set up trusts and structures that will protect these investments for your grandchildren and great-grandchildren. The question is not whether you can build generational wealth. The question is whether you will have the patience and discipline to buy simple investments and hold them forever, whether you will resist the temptation to trade, to time, to be clever. Whether you will trust the process even when markets crash and everyone around you is panicking. I have made my choice. I have told my family exactly what to do. 90% into a low-cost index fund, hold it forever, never sell. Let time and compound interest create wealth that will last for generations. The choice is now yours. You can chase the next hot stock. You can try to time the market. You can pay high fees for complicated strategies, or you can do what actually works, what has always worked, what will continue to work for as long as American business continues to grow and innovate. BY Simple Investments. Hold them forever, pass them down to your children, and let time do what time does best. That is the gift I want to give my family. And it is available to you too. But let me go deeper on something I touched on earlier because I think it is crucial for anyone thinking about generational wealth. The psychology of inheritance. This is something that destroys more family fortunes than bad investments ever could. I have watched wealthy families self-destruct over 3 generations. The pattern is so predictable, it has become a cliche. The first generation builds the wealth through hard work and discipline. The second generation maintains it because they watched their parents sacrifice and struggle. The third generation squanders it because they never understood where it came from. This is why the investments I have chosen are not just financially sound. They are psychologically designed to prevent that pattern. When your grandchildren receive dividend checks every quarter, they develop a relationship with productive capital. They see that wealth is not just a number in an account. It is ownership of real businesses that pay them real money. When they own an index fund through crashes and recoveries, they learn patience. They learn that temporary declines are not emergencies. They learn that time heals most investment wounds. They develop the temperament necessary to hold wealth rather than destroy it. And when they understand what it means to own a quality business, they appreciate the miracle of capitalism itself. They understand that wealth comes from providing goods and services that people want to buy, that profits are earned by creating value for customers, that business ownership is a partnership in human progress. These lessons cannot be taught in a classroom. They can only be learned through experience. And the investments I have chosen are designed to teach these lessons automatically over decades of ownership. Let me share another story that illustrates why this matters. In the 1980s, I met a family that had inherited significant wealth from their grandfather who had built a successful manufacturing business. The grandfather had worked 14-hour days for 40 years. He had saved and reinvested every dollar. He had built something remarkable from nothing. His children understood his sacrifice. They had watched him work. They maintained the wealth reasonably well, though they did not grow it much. But his grandchildren, born into luxury, treated the inheritance like a bank account to be drawn from rather than a garden to be cultivated. By the time those grandchildren reached middle age, most of the fortune was gone spent on lifestyle, eroded by bad investments and high fees, diminished by panic selling during market crashes. 3 generations to build a fortune, 3 decades to destroy it. I have thought long and hard about how to prevent that fate for my own family, and I believe the answer lies not just in choosing the right investments, but in structuring the inheritance correctly. First, I would establish clear rules that cannot be easily changed. The index fund cannot be sold. The dividend stocks must be held. The income can be used, but the principal must be preserved. These rules protect your heirs from their own worst impulses. Second, I would ensure that knowledge transfers along with the assets. Your children and grandchildren need to understand why these investments were chosen. They need to know the history, the logic, the principles. They need to read letters explaining your thinking. They need to feel a responsibility to preserve what you built. Third, I would create structures that reinforce patience, trusts that distribute income, but protect principal rules that prevent access to large sums until certain ages, incentives for maintaining positions rather than trading them. The goal is not to control from beyond the grave. The goal is to give your heirs every possible advantage in maintaining and growing what you have built, because the money itself means nothing if it disappears within a generation or two. Now I want to address something that might be on your mind. What about taxes? What about estate planning? What about all the complicated legal structures that wealthy families use to transfer assets? These are important questions, and I am not a tax attorney or estate planner, but I can share my general philosophy. Simplicity should guide your tax planning just as it guides your investment planning. The most sophisticated tax strategies often involve the most sophisticated fees, and those fees can consume more wealth than the taxes they were designed to avoid. The stepped-up basis that occurs at death is perhaps the most powerful tax planning tool available to most families. When you die holding appreciated investments, your heirs receive those investments with a new cost basis equal to the value at the time of your death. All the capital gains accumulated during your lifetime disappear for tax purposes. This means that the strategy of buying and holding forever is not just good investment advice. It is good tax advice. Every year you hold without selling is a year of capital gains that can potentially be erased at death. Every trade you make creates taxable events that consume wealth unnecessarily. For families with larger estates, yes, there are additional strategies worth considering: trust, charitable giving, family limited partnerships, and many other structures can preserve wealth across generations, but these should be implemented with the guidance of qualified professionals, not based on anything I say in a video. What I can say with confidence is this: the biggest tax mistake most families make is not failing to implement sophisticated strategies. It is trading too much and triggering unnecessary capital gains along the way. If you simply buy and hold forever, you will likely pay less in taxes than someone with a fancy tax advisor who trades constantly. Let me also address the question of inflation because it weighs heavily on people's minds when thinking about generational wealth. Will $100,000 today still be meaningful in 50 years? Will the purchasing power be eroded to nothing? This is a valid concern, and it is one reason why I emphasize equity investments over bonds or cash for generational wealth over long periods. Stocks have outpaced inflation significantly. They do this because companies can raise prices along with inflation, they can grow earnings, they can adapt to changing economic conditions. An index fund that tracks American business will naturally provide inflation protection because the businesses in that index are raising their prices, growing their revenues, and generating ever higher profits in nominal terms. Your purchasing power is protected not by some contractual guarantee, but by the productive capacity of the economy itself. Dividend-paying stocks provide an even more visible form of inflation protection as companies raise their dividends year after year, often by more than the rate of inflation. Your income grows in real terms. You are not just keeping up with inflation, you are beating it. Cash and bonds, by contrast, are terrible instruments for generational wealth preservation. Over 50 or 100 years, inflation will destroy most of their purchasing power. They have no mechanism to grow with the economy. They are appropriate for short-term needs, not for wealth that must last across generations. This is why I specified that only 10% of my estate should go into short-term government bonds. That allocation is there for liquidity, for near-term needs, for stability during the transition period after my death. But 90% goes into equities because equities are the only asset class that reliably grows purchasing power over very long time periods. Let me close with one final thought about legacy. When I think about what I want to leave behind, is not really about the money. The money is just a tool. What I want to leave is wisdom, perspective, and values. I want my family to understand that wealth comes from providing value to others. I want them to appreciate that patience is the ultimate investing virtue. I want them to know that simple strategies executed consistently beat clever strategies executed sporadically. I want them to feel a responsibility to preserve and grow what they inherit rather than consume it. The investments I have chosen, dividends, stocks, index funds, and quality businesses, are just the vehicles. The real inheritance is the philosophy behind them. The understanding that you build wealth slowly over decades through patient ownership of productive assets. The discipline to ignore noise and focus on fundamentals. The humility to accept that you cannot outsmart the market, but you can outweight it. If my family learns these lessons, the specific investments almost do not matter. They will make good decisions with whatever they have. They will avoid the mistakes that destroy fortunes. They will build rather than consume. And if they pass these same lessons to their children, and those children pass them to their grandchildren, then my legacy will not be measured in dollars. It will be measured in generations of financial wisdom, in families that understand how wealth is created and preserved, in lives that are enriched by financial security and the freedom it provides. That is what I hope to leave behind, not just money, but the wisdom to keep it growing forever.